I'm a DJ boy, going to Dcentral, minting NFT, from the bayous, being crypto poor but JPay rich.
And David.
Hello, hello. How's everybody doing? We've got some great panelists coming up here. Oh, a little bit of musical chairs going on first. And I'm going to let everybody introduce themselves because they're going to do a way better job than I am. Mark's a friend. I just met the other two gentlemen. We have some crossover, but Mark, why don't you go ahead and introduce yourself to the crowd?
So I'm Mark Yusko. I'm the managing partner of Morgan Creek Digital, based in Chapel Hill, North Carolina. We have a traditional asset management firm, Morgan Creek Capital, and then formed Morgan Creek Digital in 2018 to make mostly early stage investments in asset or companies supporting the digital asset ecosystem. We do a little bit in protocols as well, but mostly venture capital investments in early stage.
Awesome. Jonathan?
Hey everybody, my name is Jonathan G. Blanco. I am a founder of a startup called Niftmint. We incubated that inside of TF Labs, which is a startup studio for Web3, and happy to be here.
Good afternoon, everyone. I'm Vineet. I'm the partner and CEO of Cypher Capital. We are a 100 million personal fund that invests in crypto startups. In the fund one, we invested in over 100 plus projects. We're also building the Abu Dhabi's $2 billion Bitcoin mining farm, which will have world's 20% hash rate. It's supposed to be the biggest Bitcoin mining farm in the world. So that's a bit about me.
Excellent. That's all. Just the biggest. Dubai?
So Dubai is all about making the biggest one.
Dubai is a great place. If you haven't been there, take a visit. It's there's a lot of magic coming out of that part of the world that I still don't understand yet, but I'm going to keep going and figuring it out.
In fact, the order that we gave was $650 million of miners, which was the biggest at that time before Marathon made a $850 million order. And now $1 billion order is coming from Dubai again.
Wow. Impressive. So I'm going to this is about institutional investing, venture capital, and how that ties to Web3 and NFTs and all the DeFi awesomeness that we're here to talk about. But we're not going to stick to just that. We're going to let it flow a little bit. But I do want to point out something about Mark's fund, because it's pretty interesting how you got into crypto, right? You manage a pretty public and pretty conservative fund, which is public pension money, right?
Right.
So how did that foray into crypto? Like, how did you go from, hey, I'm managing police departments and public servants' retirement money to, hey, I'm starting a crypto fund?
Good question. So actually, even further back, started in the endowment world, managed money at my alma mater at Notre Dame, then came down and ran University of North Carolina's endowment. And it was mostly about alternative investments, hedge funds, private. And for many decades have invested in early stage funds that invested in infrastructure around technological innovation. So we were early investors in Web 1, Google, Yahoo, eBay. Turned out really well. We put $500K into Google, took out $200 million. I'm like, hey, this is pretty cool. So fast forward to the mobile net. Just launched Morgan Creek back in 2004, and we made a bunch of investments again in Web 2 and the things that built out the e-commerce space all over the world, from things like Alibaba early on, back when SoftBank invested many, many moons ago, to startups like JD.com. So we did global e-commerce. And then the short version of long tail, 2013 got introduced to Bitcoin. And I say I was not running drugs on Silk Road, not a cryptography student, didn't get it. But my friend who started Pantera said, hey, I'm going to do this fund focused on infrastructure. Like, I'm in. And I put money in that fund. It's great. It's up like 12, 13x, but I should have put the money in the Bitcoin fund. It's up 350x, but I didn't do that. And I spent a little time researching, wrote to my clients, said, hey, I think this is interesting. They're like, you're an idiot, we'll fire you, literally. But fast forward to 2018, we were fortunate. We met these two visionary CIOs at the Fairfax County Retirement System, and they got it immediately. One of the CIOs, Catherine Molnar, put personal money in our fund they were raising back in 2018, and went to her board, and I'll just paint the picture. 2.5 hours, we get to the end of the board meeting, and the guy, uniformed police officer, Harley outside, sunglasses, gun and helmet on the table, says, Mark, I hear you, but you want me to tell my guys that I just put their retirement in drug dealer money? I'm like, no. Well, I see your point. Okay, no. What I want you to say is, as a fiduciary trying to make 7.25%, you can't do that in a 2% interest rate world. You've got to focus on innovation as an asset class. This is a technological innovation that we're all coming up on, which is if you go back in history of computing, 54 is the mainframe, 68 was the microchip, 82 is a personal computer, 96 was the internet, 2010 was the mobile net, 2024 is the trust net. And the trust net is going to make all of those other technological innovations seem small. This is the greatest wealth creation opportunity I'll see in my lifetime for sure. And that vision has been accepted by about 10% of pension funds, endowments, foundations. So we're still really early. It's a long answer to your question.
Absolutely. I love the long answer. And what, I go back really quick, what year was that you convinced them that this was a good idea?
2018.
2018.
Yeah.
So even earlier. Yeah. So it's impressive.
It doesn't hurt that their investment's up tenfold, so they seem smart and they're happy. And they actually had the best performing pension fund in the country last year.
Yeah, I mean, you have the slow and steady approach as opposed to the quick flip. So, and things like Bitcoin, that tends to make sense. All right, Jonathan, let's jump to you real quick. So Jonathan's coming from a different perspective. He's a builder in the space, right? We actually just threw him on the panel last minute, threw him under the bus. So thanks for being on here. We wanted a flip side because these people are giving money to people like him for building stuff.
Yeah, hashtag building in public, right?
Exactly. Yeah. So give us a little bit of insight, like what made you, I mean, we met back in Seattle back in the day, but like give us some insights of what made you get into building in Web3 and like what is your strategy when raising money, if that's something you're doing?
Yeah, most definitely. So just a quick shout out to Mark. I remember when you announced that fund in 2018, and I remember sending articles about that to local investors in our area and just not getting replies back, right? Like, hey, like, look what's happening. Yeah. So big shout out to Mark for that.
And to that point, I just spoke to the Council on Investment Executives from Pension Benefits Association. 120 of the biggest pension funds in the world, hundreds of trillions of dollars across, many hundreds of billions, no, 100 trillions across the world. 83% no exposure. 83%.
That's crazy.
Yeah, and one thing I always love to say is like, your lack of understanding of something doesn't diminish its value. So, it really is important for investors to get to know that. But to answer your question from a building perspective, I think it's really interesting, and there's different ways to go about it. So I've been a founder my whole entire career. I've been in the retail technology space for over a decade, and I got into crypto in 2017. Doing loyalty and crypto. I'll be the first one to admit, when ICOs came out, I was like, oh, wow, this is interesting. I can raise capital doing this. And so I looked into it, and thank goodness I looked into it and realized I do not want to raise capital doing this, so we did not do an ICO. But at the end of the day, what it really comes down to is, are you building products that solve a problem, right? Web3, unfortunately, for better or worse, is, call it one of the only innovations where we actively forgive very terrible user experience and call it innovation.
All the time.
We're like, that's innovative. You have to take 9 more steps instead of that one step that you used to take. Wag me, So I think
it's also a vote of confidence that people keep coming back for more, even though it's so complicated to use.
Don't get me wrong. I think all that stuff's going to get resolved. Like
Yeah.
it will get resolved. It will get better, a bit cleaner, and so forth. But at the end of the day, is like, how do you make sure that you're building products that people want overall? And so for us, and for me as a builder, I've always just seen more of like, how do you make sure that you are actually building a company that someone would want to invest in. So I think a lot of times founders try to raise capital, frankly, way too early. It's like, I have this idea, Mark, here's my idea. Hey, here's my idea, fund me. And then they get pissed off that
where's the tech?
Yeah, they're just like, well, how did you validate it? Have you talked to customers? Like, are people like clamoring to make this?
Sure.
And maybe you don't have customers, but at the very least, like, you have a core insight that you're able to see that you can articulate as to why you're the one to solve.
But it didn't stop the tens of billions of dollars that went into fintech, and there's no tech.
Right.
I mean, we spent 20 years building fintech companies with no technological innovation. We took bad tech, Fedwire, ACH, and moved it on to better UX, UI. Yay! Awesome!
True.
We gave multi-billion-dollar valuations for a few seconds. Now they're all collapsing. But, I mean, Vineet, where do you guys see the most opportunity in the space?
So I've been a startup founder for a long time. Again, going to your point, when it comes to, there are two things. One is raising capital and one is building a company.
Sure.
Now, these are two complex things because when you are building a company, VCs are not ready to fund it because they think it will become a lifestyle business. And there are these other parts of people who go on and raise hundreds of $1 million without any business model. Paytm was a case in India which landed up at a, $6 billion valuation. Today, Alibaba came out of it at 100 million or not even some shit valuation. Point is here, the complexity is not just about founders not trying to build, but then founders also have to focus on raising capital and you have to run it on a different metric altogether. So for me, because I've been a startup founder, I bootstrapped quite a lot of companies in the last 15 years. Mm-hmm. My last one collapsed after being valued at 8 million because I was in the travel space and COVID hit. Mm-hmm. But for me, I look at a mix of both. Because in the end, you are investing for returns as a fund manager. Yes, I'm in it for the technology, but I'm also looked at as returns as well. So I look at whether these founders are real, legit. Will they do something? Because unlike 2017, they're not raising in Ethereum. They're raising in USDT. That means funds are in bank account. So I look at that. Will they build it up? And then again, the market conditions see to it that investments go well.
Well, my one knock about people, not the people walking around, I don't know the people walking around, but the one knock against our collective industry is too much money came in and backed ideas, and there was this, arms race between people like us and the big funds to give people a lot of money with, I think, lack of discipline, and so a lot of money got wasted instead of building focused solutions to real problems. And at the end of the day, this is, I think, the greatest technological innovation wave we're going to see. I think it's going to truly go exponential, but we actually have to build things that work and that can be used by people. And we got to get rid of the tribalism, right? The people sniping at each other, it's like when the kid sees mom and dad fighting and they're like, I'm out. The investors are just like, I'm out.
That's why you do it on Twitter and then it's all satire. It's not real. You can get away with highway robbery on Twitter, right?
True.
You guys all know that. So let's switch gears a little bit. You mentioned the market. So the current market conditions, a lot of people would agree, are bearish at the moment, right? Mm-hmm. Pretty bearish. How does that work when you're funding, and how does that work when you're building? It's me personally. It's one of my favorite times because it weeds out the people that shouldn't be around and the ones that are really...
The most important thing is winter is necessary. Mm-hmm. Winter cleanses the garbage, it kills off the bad stuff and allows the good stuff to grow. Part of the problem with the real economy, which is going to cause more problems soon, is they didn't allow winter to happen. Through QE, we've let all the bad companies, 40% of the companies in America, 40%, think about that. 4 out of 10 companies can't service their debt. They can't even pay the interest on their debt. Forget paying off the debt. They can't even service the debt because they don't make any money. And this novel concept of profits is really important. And so the winter cleanses, and the best investment opportunities, bar none, full stop, are in winter. Because people get displaced, and as painful as that is, they go do great things. They start new businesses, they partner with people, they bootstrap ideas, and the best investments I've ever made are in the depths of the crises. At the top, 12 months ago, you're making bad investment decisions, misallocation of capital because you're funding at too high a valuation, and we all are guilty of it. And Keith Raboy was great about this. He says, you go first. It's not my fault. You go first. You cut your valuation first. I'm just paying what everyone else is paying. No, we all were stupid. And now valuations are going to go down a lot, but that's actually a really good thing. And the people that get laid off, painful as it is a really good thing because many of them will start some of the best new businesses going forward.
The printing is probably not going to stop, though. That's a bad thing. Like you said.
It's a whole other story that the Powell pivot's coming. There'll be more money printed over the next 3 years than was printed over the previous 2 years after COVID. It's a big statement, but it's coming.
That's painful. So, Vineet, you look like you were going to say something.
So, when the winter comes or when recession comes in fact, what happens is that, those wannabes who want to raise $10 million out of nowhere sort of say, okay, it's tough now, I'll come the next season. So, you don't see them anymore. Now people come and say that, okay, my mainnet is launching. Earlier people were saying my token is launching. Again, for me, it wasn't bad because in the last crypto run, our fund did a 50x at the peak of it, so it wasn't bad. But the point is now you're seeing the real ones who want to build something, and they're the ones who are actually building some use case rather than planting trees and saying this is a crypto startup.
Yeah, hey, look what I built. Lock some in it. Like, earn. You know? Don't give me money. Earn your own.
And for us, I personally believe that investing right is three things: investing at the right place, managing your funds, and entering and exiting smart. So for us as a fund, we invested over $70 million into mining. And today I have a $10 million cash flow, and the fund in itself from day one is a 4x. So I can still take those risks which others are not ready to take. And that's how I've invested 14 startups in the last 2.5 months. So
Cash flow. What is this thing you call cash flow?
Yeah, look, ultimately you're running a business, right? So I told this to my entire team, no one's coming to save us. Okay, there's no magical lifeboat that's coming with a bunch of cash. If that does happen, amazing. But ultimately, we got to run a business. We got to make revenue. We got to continue to build the product regardless of what the market condition is.
Yeah, exactly. You take the traditional model. If you look at most millionaires on the planet, they are not tech people. They're people that build things that people need, and they do it for a long period of time, and they're very successful at it, and they rack up millions of dollars, and then they go invest in crypto, and then they find people like us like, what should I put my money in?
Yeah.
You say, do your research. Whenever people ask me, what coin should I buy? I'm like, well, I think you should do research on these things, but I'm not telling you to buy shit.
So interestingly, when people ask you what coin do you invest in, I'm not talking about the institutionals, but retail people, they really don't have a clue what the coin does.
Right.
They just invest because they saw a green candle, and this is the interesting part. When I speak on forums, I say that people say 300 million people are in crypto. I'm like, out of that is 3% of the world's population.
Right.
90% just
a bunch
wake
of
up
wallets sitting around.
Yeah, but this is 90% people just waking up and seeing Bitcoin prices. They have no clue what Bitcoin is.
Right.
So the thing is, we are so damn early in this season, and people, unlike in 1970s, we had the Indian stock market where people would invest, but didn't know that stock market is tied to the company's real business. And similarly, today people don't understand that cryptos are tied up to the performance of a Solana Polkadot. So we're too early, and people are still learning. I think by 2030 they will learn, and we'll be where we should be.
Yeah, the one thing I think is really interesting is I came out of the traditional world, introduced to this early, idiot, didn't really catch on for a few years. But once I finally did and made the commitment, what I saw, and the reason I really got behind it, was the talent migration. All of you sitting in this room, all the people walking around here, the talent migration into this space. What do I mean by this space? I mean all the development around digital asset ecosystem, Web3, whatever we want to call it, is like nothing the world has ever seen, right? The migration in the internet was huge. I mean, it was huge. People were leaving investment banking, consulting, traditional technology, and going into this crazy thing where Brian Gumbel was like, what is the internet? What is that @ symbol? And Paul Krugman, it'll never be more important than a fax machine. Maybe a little more important. And I got in this Twitter fight last night, which I'm not supposed to, but I did anyway, with this guy who was like, Bitcoin's been around for 13 years and it's still looking for a use case. And I'm like, okay, compared to what? He says, well, email. Like, first email was sent in 1971. 10 years later, the term email was coined. 10 fucking years before it was called email. Okay? 10 years later, the first actual mass market product, Hotmail, was created. 20 years. And it's the problem of capability versus potential. How much would you have paid for the future earnings potential of 9-year-old LeBron James? Now, I will show you a picture of 9-year-old LeBron James, and you'd say, I'd pay $10 for that. That kid looks like he's small. He doesn't look like anything. He looked like any other 9-year-old. But if you would have bought that potential, okay, where the potential to capability ratio was really high, you would have made a lot of money. He might be worth $100 billion someday, right? That's what Pomp said the other day. And I think it's probably true. I mean, he said he was going to be a billionaire. He is. And the potential of what you all are doing, or y'all, since I'm from the South now, I just can't get used to it. I say use guys, and it's just like...
Y'all, it's y'all.
I know it's y'all, but I can't say it. Anyway. But I get really excited. I did a day trip out to Seattle to be on Jonathan's show last week because I believe in what he and the other builders in Seattle are doing. That's my hometown. And it's exciting to be around creative, driven, motivated people. And if I can give them capital, that then they multiply and I can just go home and sleep, it's awesome.
That's right. Love it. All right, so we got just a little bit of time left. I want to switch gears. Quickly, equity versus tokens, the founder's dilemma. What is the best route? Because a lot of people want to sell a token because they think they can sell it, but they might not need it for their company. So equity versus tokens. I guess, Jonathan, as you as a builder, you go first, and then we'll talk
Yeah,
about VCs.
so from a founder, honestly, I don't know why any founder would want to sell tokens, especially because regardless, so first off, you're going to have to somehow figure out how to manage secondary market activity, whether you're doing so with market makers or you're doing so, behind the scenes. That all happens. If you think it doesn't happen, be surprised. So for you to introduce essentially new market behavior to how you're building your company, I just think that's incredibly difficult. One. Two, if you're going to traditional investors, most traditional investors are going to laugh that out of the park. And then three, even if you go to blockchain, Web3 focused investors, there's only a select few that'll actually take those tokens. And oh, by the way, you better be careful that you're not having an investor take those tokens, have them run it up, and then dump it on an exchange, and now everybody's pissed. So I don't know why you would want that headache from a founder perspective.
It's true. If you're going to have it, you better know how to play the game better than the people who are holding it, because they will outgame you.
Luna comes to mind.
What happened there? That's a whole hour-long panel that we can get into.
No, it's just other people. Ken Griffin knows how to play the game better.
Yeah. Yep.
So again, there's another perspective to it. I ran a startup for 8 years, valued at $8 million. We were having revenue as well, $500,000 a month. And then COVID came. The equity had no secondary market, not for me, not for investors. So, people prefer investing based on their experiences. My experiences with the equity have not been great. So even as a startup founder, imagine you're stuck with 80% or 60% equity and suddenly something happens, you have no money in your hand. So one is that perspective that yes, it gets liquidity to the whole thing, but then you also have to do your due diligence whether the investor is a dumper or he is an investor who looks at long-term. Long-term investors doesn't mean that they cannot sell. There's difference between dumping and difference between selling. If you look at any IPOs that have happened, investors have always sold a part of their investments to cover their initial in. This sees to it that they have an ROI for the fund. If you don't sell, there's no ROI technically. It's all virtual.
Yeah.
So,
and Vineet brings up 2 points. One, in venture, it's not what you got, it's what you got out.
Yeah.
What you got on paper does not count. It's what you got out and turned back into whatever you want currency you want to use. Second thing is, I agree with Vineet that spent most of my life in the equity business. 70% of what we invest in our funds is equity. We've done 69, not 100 investments. But 30% of what we do is in the protocols. And the reason is, in Web 1, all of the wealth went to the application layer. Nothing went to protocol layer. Tim Berners-Lee invented the internet. He is not a rich guy, although I do love the fact that he took his 9,500 lines of code, turned it into an NFT, sold it for $5.3 million. Awesome. But he invented the internet using TCP/IP. We use TCP/IP every single day. No one gets to own it. 85% of the value in Web 2 and ultimately Web 3 is in the protocols. 85%. So all these great companies, Coinbase, BlockFi, Figure, all these things that have gone up worth tens of billions of dollars, it's $250 billion total. The protocols are, 7 times that. And so you have to at least acknowledge, like my best investment ever, and I didn't make it, glory, hallelujah, Kyle, wherever you are, love Austin, okay, most money I've ever made in my life, and I didn't do it. I just gave Kyle some money, and he put it in this little thing called Solana, and unbelievable. That's a token. Now, would I have made that investment originally in the token? No, I would not have. But I'm happy I got exposure to it.
And I guess I should clarify, at a protocol layer is the only time I think it would make sense to raise with the token. Outside of the protocol, if you are not creating layer 1 or bare minimum layer 2, don't even say the word token that you're in my opinion.
Yep.
Ditto.
Again, one more thing that I should, the founders should actually look at is, building tokenomics is important. You know, why should someone hold your token? Why should an investor be scared of selling your token? And no one puts energy on that. You know, when you look at the Binance coin, when I bought Binance when it was $5 or $6, went on to whatever, 500-600. The thing was, I from that day onwards, 2 years back, knew that they're doing these token launches where if you hold 100,000 BNB, you actually end up getting part of these tokens. And all those tokens were doing 100x on Binance.
Right.
So the thing is, the founders need to focus on the utility rather than the bloody price.
Yeah,
right.
but the one risk, and again, I'm going to make myself really unpopular and not get invited back. We're all in for some really bad times because there's a whole bunch of stuff that still needs to go to zero.
Yeah.
Doge needs to go to zero. Shiba needs to go to zero. They have no value, no use case, nothing.
Sub-public companies too.
And those two things have $16 billion of market cap. They will go to zero. And that's going to cause people like Janet Yellen and others to say, see, I told you this is risky. And look, 2009 to 2015 was the first they ignore you phase, right? The famous quote from Gandhi that Gandhi didn't say. I don't remember who said it. But first they ignore you, okay? Then they laugh at you. So 2016 to 21 was then they laugh at you. Oh, look, a bunch of nerds and geeks, okay? Now they fight you. So 2022 to 2027 is the then they fight you phase. And the fight phase is coming, right? You think Yellen, the next day after Luna, talking about stablecoin regulation, you think that was an accident? It was not an accident, okay? Regulation is coming, and it's going to be hard.
Yep.
And a bunch of projects are going to get obliterated. They're going to go after securities. A whole bunch of tokens are going to zero. And that's going to cause all of us doing real stuff heartburn.
Yep.
And so we got to overcome that. We also got to get rid of the tribalism in pointing fingers at everybody back and forth. Like I surf spaces at night, and I'll go to Bitcoin maxi rooms, and they're like, oh, you're a shitcoiner, get out of here. I'm like, what are you talking about? I own more Bitcoin than you by far. And they're like, and then I'll go to a Web3 room, and they're like, get out of here, you're a maxi. I'm like, no, I've invested in more Web3 projects than you. And it's really weird, the tribalism, and that needs to go away. We are all in this building together.
Yeah, absolutely. And they do, as your point earlier, they do call it the bleeding edge for a reason. I do think there's a lot of bleeding coming soon. But at that rate, we are out of time. Thank you so much for your awesomeness today. And thank you, everybody, for showing up. Thanks to Justin Wu and all the sponsors. Much appreciated. Love y'all. Take care.